Does preparing for retirement keep you up at night? Well, let us help. In our free ebook, 5 Essential Steps to a Well-Funded Retirement, you'll learn how to save, how to potentially make up for lost time, how to fight inflation, how to create investment strategies to help protect against recessions, and more. Get our free ebook now at TRADEway.com/retirement. That's TRADEway.com/retirement. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome back to the podcast. Hey, we've been talking about what the Bible teaches about proper diversification and how TRADEway has a division called AMPT that helps you invest your long-term retirement funds, and how we built this system from Scripture. And if you've been listening, if you haven't, you can go back and catch the archives. It's pretty interesting because we're talking about how in Ecclesiastes chapter 11, God tells us to diversify into 7 or 8 major groups, and we kind of pointed out how TRADEway does that. And then in Ecclesiastes chapter 27, it talks about at least 16 subdivisions that you can put into those, especially with regard to U.S. equities and how we actually built that into AMPT. And last time we talked about how in Ezekiel 27, written over 2,600 years ago, it mentions things that allude to modern industry groups like transportation, mining, consulting businesses, technology, automotive. You might say, how does it talk about automotive? Well, it doesn't. It talks about transportation. But as you use that as a type or an example for those of us who live in the end times, that can be automotive. It can be airlines, things like that. And number 6 was building, commercial and home building. Number 7 was jewelry, clothing, and housewares, and that's kind of where we stopped last time. So let me pick up right there, and we're in Ecclesiastes chapter 27, and we'll pick it up with verse 17. It says, Judah and the land of Israel, they were thy merchants. They traded in thy market wheat, minneth, and penag, and honey, and oil, and balm. And obviously, these are talking about commodities. And so there's a whole arena in the modern financial world where you can look at ETFs that are based on commodities. You can have, non-animal commodities like wheat, corn, et cetera, and then animal commodities like cattle and sheep and things like that. And you can buy ETFs like a stock that track these things that were spoken of 2,600 years ago in God's Word as part of what we invest in. And then it also speaks of manufacturing, merchandising, and exporting. It talks about wine and wool and exporting, these sorts of things. Verse 19 says, Dan also and Javan going to and fro according to thy fairs, bright iron, cassia, and calamus were in thy market. And some of these types of things were used for medical medicines and things like that. So that would bring up the industry group of medical, pharma, biotech, things like that is what that can allude to. And then aromatic oils were used for worship and also medicine. So that supports that as well. And then it says, Dedan was thy merchant in precious clothes and for chariots. Now, what were chariots? Well, that is a military contractor, right? They were used in battle. So you take your companies like Boeing and some of these companies that build all the military things that we have, you can buy stocks in any of those companies, and it would fit within this category. And in verse 21, Arabia and all the princes of Kedar, they occupied with thee in lambs and rams and goats, and these were thy merchants. So here we have the animal side of commodities trading, cattle, sheep, goats, etc., which today you can get in the commodities market easily, either literally get into it or through ETFs, which is more like just buying stocks that track these things. And in verse 22, the merchants of Sheba and Ramah, they were thy merchants. They occupied in thy fairs with chief of all spices and all precious stones and gold. And you keep reading into there, and it talks about all different kinds of things you would buy at a grocery store. So there's the whole entire grocery industry. And then precious metals are mentioned in verse 23 and 24. Haran and Kana and Eden, the merchants of Sheba, Asher, Chilmad, these were merchants. These were the merchants in all sorts of things, in blue, clothing, embroidered work, in the chest of rich apparel, bound with cords and made with cedar among thy merchants. So all kinds of precious metals and clothing retailing, things like that are mentioned there. The ships of Tarshish did sing of thee and thy merchant, and thou wast replenished and made very glorious in the midst of the seas. It's talking about how the economies can grow and grow through these investments. The rowers have brought thee into great waters. So here we have transportation and shipping. The east wind hath broken thee in the midst of the seas. When thy wares went forth out of the seas, thou fillest many people. Thou didst enrich the kings of the earth with the multitude of thy riches and thy merchandise. So there gives you a little clue on wealth creation through these types of businesses. And it can even talk about multinational conglomerates, because here it's talking about people that are doing business in many different nations at once. And so that's a whole industry group in the modern world. So this is how we created the things we invest in AMPT. And I would say it is probably the only biblically based investment instrument in the world that I know of. And take a look at it. Go out to TRADEway.com, take a look at AMPT. And I want to use the rest of the time we have in today's series to talk about some really good reasons why you might want to consider AMPT. Okay, first of all, let's talk about the fact that truly most financial advisors have been taught by the companies they work for to tell you phrases like, well, just stay the course. Don't go try to buy and sell your stocks because of fear, because markets always come back. Well, maybe they're right about that, but they don't tell you how long it takes. So if you go back to the 2000 dot-com crash, the market lost 50.5% of its total value in 31 months, and it took 15 years for the NASDAQ to get back to where it was before the crash. Now, that means you had half your money to get back where you were, so it took more than 15 years just because the NASDAQ made it back in 15 years, but you only had half the money to trade with, so it took probably more like 20 or 25 years to make that money back. So not only did you lose the money, which you eventually would make back if you were 20 years old or 30, but if you're 70, you won't. If you're 65, you will not if all you know how to do is buy and hold. Not only that, you have an opportunity cost because you made zero return all of those years you were just making back money. You weren't making any new money. And they don't tell you that. So what we do at AMPT is, and we've been quite good at it, you can check out our archives and you'll see that we have warned our clients anywhere from 1 to 15 days prior to major corrections and market crashes. We have warned them to go to cash so that they're not in the market when it tanks, so that when it gets down to the bottom, they still have the cash that they had and they can reinvest that when all the stocks are cheaper at the bottom of that bear market when the next bull move is starting. And if you can do that over and over again for 3 to 5 years, or if you're young for many, many years of your life, can you even imagine what that would look like if every time there's a market crash, you don't lose half the money on paper and then have to make it back? And even if you didn't sell it in the 2000 crash, it still took 15 years to make it back. And think about that. That is 15 years of opportunity cost of zero return if you have an advisor who just leaves it in. So at AMPT, we don't leave it in. We go to cash. And sometimes we buy inverse ETFs that actually have potential to make money on the way down. Now, the 2008 Great Recession lost 57.69%, and it did it in just 17 months. Now we're in the 2022 Biden bear market because this recording is done on July 3rd, 2023. At the very first of the year, we had a bear market for an entire year. The whole year of 2022 is in a downward trend, and it was start of a bear market. Now, what's interesting is because the Fed is raising interest rates right now and decreasing the monetary supply, this has always been predictive of a recession. So we're not even to the recession yet, which we think would hit sometime around October of this year, at least by then, if not sooner, and last throughout 2024. And new bull markets never start before the recession. They start when it's almost over. So this little move up that we've had, this attempted rally, I don't believe is a true bull market. I think it's just an attempted rally, and I think there'll be another leg down in the Biden bear that will last through the end of 2024. We'll see if I'm right, but there's a lot of reasons. I'm not the only person that thinks this. In fact, I would say 9 out of every 10 economists you read about right now, roughly at least 8 out of 10, will tell you we've got a recession coming, and 2 of them will say, oh, no, this time it'll be different. Now, let me just tell you something interesting about that little phrase, this time it'll be different. You can go back and read things that are written, Wall Street articles that they want you to read and want you to obey. And before almost every recessionary bear market crash, there would be 3 or 4 writers saying, oh, well, all the signs are saying recession, but this time it'll be different because ... And then they'll tell you the reason why. Well, circumstances are so different now than they were. It won't predict a recession this time. And then the recession happens in the bear market and people lose their money. That is, I've just seen that again and again through my 40 years of experience. And they're saying it again. Not many people, but it's funny. We just had a big live TRADEway meeting in Dallas this past weekend. And the first day I told them, I wish I had gone and clipped one of those because I know there's some out there. There got to be a couple of articles where they're saying, well, this time it's different. And it's funny because the second day we had a session where my son-in-law, Dave Huber, was just going to click through some actual financial articles online, and we were giving him examples of which ones are real and which ones are fake. One pops up and it says, well, this time it's going to be different. And everybody in the room laughed, and we read the article because it was one of those. But 8 out of 10 people agree with me that, and I'm talking about some of the great economists who work for big trading firms or who work for the government and all over the world, are saying that not only the United States, but the whole world is about to enter a recession. So things we're looking at AMPT, we're looking at key news items that have to do with inflation, that have to do with the banking system stability, or instability might be a better word. We're looking at the decrease of the money supply that has always, I won't say always, but 9 times out of 10, it predicts the next recession, because as the Fed raises interest rates, it lowers the money supply, and therefore small and mid-sized businesses cannot get loans. They can't build their businesses, so they lay off people. They lose their jobs. Now they can't buy the products. Now the bigger companies have to lay off people, and it just creates either an inflationary or in some cases a deflationary spiral, which is even worse. And so all of the signs are there. I'll show you some of them here in a minute. But we're looking at the money supply. We're looking at especially the 10 and 20 and 3-month Treasury yields, which are now, the yield curve is inverted. And the last 6 major recessions, which to me are the only ones that even matter, because if you go back in history before that, you didn't have the internet. You didn't have millions of people trading in the market like we do now. So things were different. But now, for that long, it's been very similar, and all 6 recessions were preceded by an inverted yield curve. Now, what do we mean by that? Well, if you go out and you just look, I'll give you the most recent one that I've got here. I clipped this out, I think, last Thursday or so. But the 3-month Treasury yield, and what that is, that's where the government sells bonds to raise money to run the government. And they're supposed to be the safest investment in the world, right? And so, because it's backed by the U.S. government. Well, the 3-year Treasury bonds were going for 5.19, almost 5.2% interest. If you bought a 30-year Treasury bond, it was only 3.9% interest. Now, why is that important? Well, think about it. When the world is working correctly, the economics are working fine and we have a great economy, normally the farther out you buy a bond, the riskier it is, because the interest rates can change and you have what we call interest rate risk. So they have to pay you a higher yield or a higher interest rate to get you to buy that. And then the shorter terms would have a much lower interest rate because they're not as risky, because like a 3-month bond, you get your money in 3 months, you go buy a different one. So if the interest rate starts changing, it doesn't present quite the risk because you can get out of it in 3 months. You don't have to hold it for 30 years. Well, now, why is it that the 3-month, which is less risky, gives you a 5% interest rate, and the 30-year, which is way riskier, gives you only 3.9. Well, that's called an inverted yield situation, and always, every 100% of the last six, and this goes back into the 1980s, major recessions have been predicted by an inverted Treasury yield chart. And we've had one now for almost a year, and when you look at every one of those six recessions, it predicted it, but there was a lag of about 1 year, 12 months to 18 months before the recession hit. Well, we've had an inverted curve now for over a year. And so we are coming into a time period where if we don't get a recession, it will be the first time that's happened in the modern era, if you see what I'm saying. So, I mean, if we play by the math, if we play by the probability math, which is all we've got, we can't tell the future, but God did give us probability math, there's an almost 100% likelihood of a recession starting sometime around October of this year and going throughout the year of 2024. And AMPT takes that very seriously. We already have our clients 70% in cash and about 30% in inverse ETFs that have the potential to make money on the way down. And so we're ready for this. And whenever this thing happens, we've got plenty of cash of our clients that we can put into bearish investments, such as inverse ETFs. We can buy puts in companies that are going down because that has potential to make money on the way down as well. And most of your financial advisors don't try to make any money on the way down. In fact, they don't even go to cash. They just stay in the stocks and lose 20, 30, 40% of the money. It's totally not necessary. And this is one reason I recommend AMPT. When you look at some of the things out there that all economists will agree with me in the fact that they predict recessions, you can look at the inflation rate. And I'm looking at a chart right now. I realize you can't see it, but it shows a little blue line, and every time that blue line moves up, which tracks the inflation rate moving up, there is a wide gray bar going down the chart, which is showing a recession. 1974, 1980, 1990, 2003. Well, actually, it was the 2000 tech bubble burst. Same thing. Inflation was moving up in a straight line right before that happened. And right before 2008, same thing. And now if you look at right now, I would say I'm looking at this chart, and the inflation line is approximately 5 times higher than any of the ones I just mentioned, except for the year 1980 when Jimmy Carter was president. And so this indicator is 5 times higher, indicating a recession than it has the last 5 or so recessions. And that's the inflation rate. Now, I know they're trying to raise rates to make inflation go down, and they're talking about how, it's going down a little bit every month. But what they're not telling you is they're talking about the overall inflation rate, but the Fed looks at the inflation rate minus transportation and food, and that one has stayed right around 5.5 to 6 all year. It's not moving at all. So inflation is kind of staying the same, and it's not getting better. And if you look at the overall inflation, they're trying to get it from, right now it's approximately 4, trying to get it to 2. That means they got to lower it by 200%. And they talk like, well, it's gone from 7 to 4, so that's a good thing. Well, yeah, it is a good thing, but the last 2% is usually the most difficult because inflation tends to be sticky. It doesn't tend to just go away quickly. And if you look at how long it took Reagan to correct the Carter screw up, it took years. It took over 5 years of raising rates to get it back down to 2, to get inflation from 2. And Carter had it way above 10% to get it down to 2. Well, Biden had it up close to 9 at one point for a day or two, but they've gotten it down to 4. But to get it to 2, it's going to take time. It's not going to happen in months. It's going to be a year and some months, maybe 2 years. And then another one, we can look at the core inflation rate. Like I said, it just hasn't moved down much at all. That's why the Fed is saying they're going to raise rates 2 more times this year. And when they do, the stock market hates that. So if you've got your money with a financial advisor who just believes in sticking to the course, you might want to rethink that because the red flags are everywhere. So now when we look at the money supply, which to me is the most important indicator, one of the most important in the top 2, okay, we have the M1 money supply and the M2 money supply. M1 is kind of what you think of as money. M2 is that plus debt, credit cards, and it adds all that because that actually creates money as well. Actually, the Fed looks at M2, but let's just talk about it in terms of the money supply. You can't see these charts anyway, but if you could see this chart that I'm looking at, you would be really frightened right now if you have your money with a financial advisor that's going to leave it in all the way down and stay the course, because this line goes almost flat from 1960 all the way to 2020 when Biden became president, and then it shoots straight up, and it moves up from, I'm looking at the chart here on billions of dollars of money supply, and it moves from roughly 1.5 billion, which is what it was just before Biden became president in 2020, till now, 2023. And just in that short period of time, it's moved from 1,500, but that's in billions. It's moved to 7,000. So the money supply is just straight up from 1,500 to 7,000 times $1 billion. That means we have printed so much money that it's amazing to me that the inflation rate, it went to 9. I figured it'd go to 15. And it still could if they don't kill it. But we have a pretty good Fed leader who is realizing he's got to raise those interest rates, even if it kills the economy, or else inflation is going to kill everybody. So this is quite a frightening chart that I'm looking at here. You can look at this chart on yields, where as the Fed raises the interest rates, you then have recessions. And I'm looking at that chart, and all these things are quite amazing to look at. Now, as I look at the M2 money supply, I've got another chart where it charts the money supply in a red line going up and down, and then it's got these thick gray lines going down, which show where all the recessions hit. And every time that I am seeing a recession from 1960 all the way until now, right before that recession, I am seeing the red money supply line move markedly down, where the Fed lowered the money supply so people cannot get loans to keep their businesses going. They can't get loans for mortgages to buy houses, so the housing industry tanks. The commercial housing industry, the commercial real estate industry right now is so frightening. It's one of the things we're looking at for possible systemic problems in the entire economy, which means that one industry could tank the whole economy because it could put banks out of business. Because you've got literally, I read articles every week, all the time is what I do, every day. And what I'm seeing is that billionaires have skyscrapers in Chicago and New York City and Detroit and LA, and they are walking away from those buildings and letting the bank have them. These skyscrapers worth multiplied millions, I should say, of dollars. And what's frightening about it is because of the laws that our government has written for the banking industry, which is different than any of the rest of us. All the rest of us, if we cook our books, we go to prison. But the banks are allowed to do what I call cooking the books, even though for them it's legal. They still have all that commercial real estate on their accounting books at the value that the building was prior to COVID, okay? But what do you think the real value is if they're walking away from it? It's zero, and they've got it listed at multiplied millions of dollars. So think how many banks are in trouble right now that did these commercial real estate loans, and people are just walking away from the property, giving it back to the bank, and the bank's not in the real estate business. It doesn't know what to do. It has to sell it on pennies on the dollar. And so I tell you, the money supply thing is they lower the money supply where and they raise the interest rates, these banks get in trouble. We've already had 3 go up belly up, and some of them be bought by bigger banks so that people didn't lose their money, because they're trying to keep you from going and taking your money out of the banks and creating a further problem. But that isn't over yet. So when you start to see that, I believe between now and October, we'll see it, because they're going to raise the rates 2 more times before this year is over. And it's going to start affecting the banks again, I believe. So here we have another chart I'm looking at where it shows the Fed's fund rate. That just shows the interest rates moving up. And you've got this little black line as it moves up. All of a sudden you see one of these gray bars moving down, which indicates a recession. Every single recession from 1955 to the present that's ever happened, that particular fund rate or the interest rates were moving straight up as the Fed raised the rates on purpose and it created a recession that tanked the economy in order to tame inflation. I've done studies on this my whole life. Every single recession and bear market we've ever had was not like death by old age or natural death. It was killed. These bull markets didn't die a natural death. They were killed by the Fed. And the way they kill them is by raising the rates. They've already done it almost every month throughout 2022. Now they're going to do it 2 more times. And they've done it several times this year. In fact, the only time they skipped was this month. And they only just let it rest for a minute. And I don't think they should have done that because they take the risk of flaming up inflation again by doing that. But anyway, they're going to continue it. It's always brought, a recession and a bear market. These are the things we look at. And I think I already mentioned the inverted yield curve. I'm looking at a chart here. It's got the same gray bars, which shows where the recessions were right before every single one of these from 12 to 18 months prior to it. The yield curve inverted, where all of a sudden the 30-year yield was lower than, say, the 3-month or the, usually what they go by is the 2 and the 10-year, but the 10 is lower than the 2, which is inverted. It's upside down and backwards and makes no sense if things are normal. So it shows that the bond market thinks things are not normal and there's about to be a stock market crash. Now, my whole life I've known this, in my own studies, reading, works on bonds and stocks, the stock market, finance, textbooks and things. We always call the bond market intellectual and we call the stock market emotional. So which one do you think you should listen to with regard to whether a recession's coming? Should you listen to all these Wall Street dudes that work for stock market companies and indices and, major mutual funds and things like that? And they're saying, oh, we're probably not even going to have a recession. It's going to be very mild or very soft landing because the economy is so strong right now and consumer sentiment is so high. By the way, that's another chart you can look at. Before every recession, you could draw a line of consumer sentiment where just the average person on the street thinks things are great. It goes straight up, higher and higher, and then there's a recession. So they get it backwards. And those are indicating recession too. But anyway, who would you rather believe? Would you rather believe the stock market gurus who are saying it's going to be mild and a soft landing, or would you rather believe the bond market, which is saying we're about to have a major recession? So if you look at all of the bond market indicators, it indicates a recession. And then there's even a chart on what we call leading economic indicators. It takes all of them and puts them into one chart, one graph, and it's moving down like crazy. And here's my favorite. It's the cardboard box recession indicator. Now that sounds funny, doesn't it? But if you look at this, since 2020 till now, the amount of cardboard boxes that have been manufactured and shipped out and sold has tanked. And it's gone from 10% growth to minus about 12% growth right now. So what does that tell you? Every product and good that's ever bought in this country is shipped in a cardboard box. So the retail people are already having problems. I mean, their inventories are growing because people aren't buying the products. So they're not sticking them in the cardboard boxes and shipping them to us. And now you think about Amazon, how many boxes they buy, and yet this is a straight down graph from 2000 till now, going from 10% growth to minus 10% recession in cardboard box business. Now you may think that's funny, but those are the things that I look at, and many economists look at that. And so I would say the yield curve inversion is the main one. The money supply is the next one. But look how many we've mentioned. I read an article just 1 week ago. It said short sellers are betting more than $1 trillion against the U.S. stocks after this last big rally. $1 trillion. The big boys that know what they're doing have bought $1 trillion or have shorted $1 trillion worth of stocks, which means they're betting against the market because shorts make money when the market goes down. And the short interest exceeds $1 trillion as of last Friday. And guess what the top 5 stocks are that they're shorting? Tesla, Apple, Microsoft, NVIDIA, and Amazon. And those are the stocks you are buying right now. The big boys have shorted them to the tune of $1 trillion. You might want to take your profits, okay? Just think about it. That comes after this big stock market gain while people are just out of fear of loss, they're buying stocks. And you know what we call that? A late stage move. So you've got an exhaustion move where the S&P is accelerated so much that the slope of it is way steeper than it should be. And at the same time, you've got late stage bases on all these stocks, which means the uptrend is about to stop working, in my opinion. So just be really careful right now. And if you've got, a financial advisor who is going to leave you in because you lost 30% in 2008 and maybe it made it back, but you don't really feel comfortable doing that now, you might want to check out AMPT at TRADEway.com. I need to stop because we're almost out of time, but I got to give you two more thoughts here. I just now thought about this. There's a man that I admire named Henry Bloget, and he is the chief executive officer of a company called Business Insider. And I read a lot of their articles. Their financial and economic articles are not fake news like so many out there because they're actually giving you actual economic data, because they don't work for fun. They don't manage mutual funds and things. They sell data to the guys that do manage the mutual funds. So they're giving you actual information. And this man, I'm going to give you a couple of quotes. One thing, and I just clipped these out last week. He said the stock market is twice the level that it has been historically. And what he means is the price earnings ratio is 2 times higher than it should be on average. And that means that stocks are so expensive right now that if you buy them, you're not getting a good deal. And when that happens, we call that an overbought situation. People tend to take profits and the market tanks. The second thing he said in the same article, he said investors should be fully prepared for a market pullback of 50%. I mean, the S&P would drop way below 3,000 if that happens. And so these are the things out there. I mean, there's this guy named David Rosenberg who's a well-known research analyst, and he said that this market right now is the first thing that he's seen since the year 2000 that looked exactly like the dot-com bubble of 2000, when companies like Dell almost went out of business. And right before that, they were the hottest company in the world. And it looks like that right now, he says. So we need to be very careful. And I hope you will check out AMPT for your long-term investments over at TRADEway.com. And I think that you will enjoy the fact that our primary goal is safety and protecting your hard-earned money, not making high returns, but we still try to get you a good return. I'll give you an example. If you look at 2022, the NASDAQ was down over 30%, and the average 401k was down over 30% for that year. And AMPT clients, some of them made a slight positive return that year, and some of them made a minus 1%. So we beat the NASDAQ and the average 401k managers by 29% in 2022. And that may be apples and oranges, because who knows how they invest. But I'm just saying, I'm just using that as an example to show you that our number one goal is the preservation of your wealth. And that's what we will do at AMP. We'll try to get you a good return too, especially in good years. But we're not in a good year right now, so we want to preserve your wealth. So check it out, TRADEway.com. I hope you enjoyed the show today. I hope you'll rate and review it so people with similar interests can find it. Maybe we can be a help to them too. Hope you have a great day. See you soon.